Do you know the most popular questions that people are asking about annuities? Well, if not, Google does. And that's what we're going to be talking about in our financial freedom video. We're going to be talking about 4 of the most popular questions that people are asking Google when it comes to annuities. So stay locked in. My name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, most people usually don't like something because of maybe what they heard or maybe what they read, but no other financial product gets the short end of the stick like annuities. So why is that?
You know, you're absolutely correct about that because of what you said. It's usually because of what they have heard or maybe what they have read. And a lot of times when you're reading or hearing anything, it can be met with biases, good or bad. But the one thing that you did not say is that they do not like something because of what they were educated on. That is the key element, Andrea, to removing any type of biases, no matter what it may be. You have to get educated about any said thing, because when you're educated and you know the ins and outs of any type of product or any type of thing that you're going to be dealing with, and you know the pros and cons, at that point you can then make an informed and educated decision about that particular thing. And so today, that's exactly what we are going to be doing, Andrea. We're going to be talking about how to remove some biases regarding a very controversial product like an annuity, because one of the best ways I thought we can do that is find out what are people asking Google. And so we are going to talk about the 4 most popular questions that people are asking Google about annuities. But before we do that, we have 2 rules to retirement income that we like to give you. And Andrew, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
Okay, so let's go ahead and jump into our lesson today and go ahead and talk about the 4 most popular questions that people are asking when it comes to annuities.
So Carson, a lot of these questions are posed by our clients, but according to Google, one of the top questions that people want to know is, are annuities a good investment? So how would you answer this question?
You know, I think that is a very important question, but I would have to answer it this way, Andrea. I would not say that any investment is good or bad. As a fiduciary, as you know, we do not see things from that spectrum. We're going to look at things from the vantage point of saying what's going to really be suitable for the client based off of their short, mid, and long-term goals. But with that being said, of course, when it comes to any financial product, and annuities are included, being the be-all to your retirement plan, I don't think that's a good idea at all. And I would say that about, like I said, anything from mutual funds, whether it be CDs or cash or bonds. I don't think one particular product should be the be-all to your retirement goals. But here's what I will say is that when you're talking about a very specific area of your retirement goals or your retirement income plan, an annuity can be carved out to fulfill that particular area. So for instance, if you've already perhaps maxed out all of your other retirement plans, like your 401ks, and you're looking for other places to put away money, putting money inside of a non-qualified annuity could be a pretty good idea to help complement your retirement goals. Because I know, at least for my clients, that non-qualified annuity, Andrea, can accomplish 3 critical elements for my clients. It can provide the safety that they're looking for when they retire. It can also provide some modest growth as well that is needed to help combat inflation. And of course, it can provide income for life. These are the 3 critical elements that I know that my clients enjoy. So with that being the case, I wouldn't necessarily say that annuities are good, and I wouldn't necessarily say they're bad, but I do think that they can be an appropriate solution to help fulfill a certain element of your retirement plan.
Well, Carson, that's a very balanced answer to that question. But another question, one of the top questions on Google that people ask is, are annuities taxable? So what's your take on this question?
Here, Andrea, I would say, yes and no. Okay. because there are certain annuities that are taxable and some that are not. So let's go ahead and break this down. Let's say, for instance, that you have a qualified 401k, and when you're done with that 401k, you decide to roll it over into a qualified annuity. Well, in that instance, when that money comes out of that annuity, that money is going to be fully taxable at your ordinary income tax bracket. But as I mentioned earlier, you can also put money into what is known as a non-qualified annuity. Now, from this instance here, the money that goes into it will be after tax. So when the money comes out, the money is going to come out in a tax advantage way. Now, when money comes out of a non-qualified annuity, the money that you put in is going to come out, and they're going to also take out money that may have had growth as well. So the interest that you've earned on that annuity is going to come out with the money that you've actually put in. Here's what is known as the annuity exclusion ratio. So the money that you've obviously put in will not be taxable, but the money that has grown inside of that annuity could be taxable at your ordinary income tax bracket. So that's a tax advantage type of annuity where you've put money in after tax, and the growth only is going to be taxable at your ordinary income tax bracket. But they are going to miss it with the money that you put in and some of the growth, and therefore you have this annuity exclusion ratio that makes this a very favorable situation for most people who are going to receive money from a non-qualified annuity. But with that being said, you can also have a Roth annuity as well, Andrea. So if you have a Roth account, and let's say you had a Roth 401k, or maybe you had a Roth IRA, and you wanted to have that money protected in some way, and therefore you roll that money into an annuity, it's going to be like to like. It doesn't change tax specifications from that standpoint. When it goes from a Roth IRA or Roth 401k into a Roth annuity, the money from that annuity that comes to you is going to come out exactly the same way as it would in any Roth IRA. Therefore, in this instance, the money that comes out of a Roth annuity is going to be completely tax-free. That is why I say yes and no. It depends on how you actually set up your annuity. An annuity can come in all different shapes and sizes, and they can also be formulated in different tax specifications as well. So it just depends on what type of annuity you establish on how that annuity is going to be taxable.
So Carson, another popular question that was asked on Google is, are annuities safe?
You know, that question, of course, we get asked all the time. And once again, I'm going to start to sound like a politician here, and I'm going to have to say yes and no. Because when it comes to annuities, they do come in different styles. When it comes to a fixed or fixed index annuity, Andrea, those types of annuities are completely safe. That means that you cannot be affected by any market volatility whatsoever in that particular type of annuity. The only way that you can lose money when it comes to a fixed or fixed index annuity is when you actually pull money out of it before the end of its term. That is known as a surrender charge, but you voluntarily made that choice. So for instance, if that annuity has a 7-year surrender charge and you decide to pull that money out in year 5, you may not have lost any money along the way, but you may suffer a surrender penalty for taking that money out early. But when it comes to a different type of an annuity, you can lose money, and it's not always safe, and that is known as a variable annuity. A variable annuity works much like a mutual fund, and you can invest money into sub-accounts in that variable annuity. And of course, just like a mutual fund, the money can go up with the market, and the money can also go down with the market. So when it comes to a variable annuity, you have to be careful, because that could be a double whammy. Because what if you surrender that variable annuity before its term, and you've also lost money due to market volatility as well? And that is why it depends on what type of annuity that you decide to choose when it comes to your money, because some you can lose money and some you can't. And one last thing that I do want to note when it comes to the safety of annuities is that unlike your bank products like a CD or maybe cash that you have in the bank, it is not FDIC insured. So annuities are not FDIC insured, but they are backed by the solvency of the particular company that you're working with. which is why it's always important to work with an advisor who can help you choose a company that has the top ratings. And it's also backed by a state guaranteed fund as well. So even if said company goes under, there's a state guaranteed fund that all insurance companies pay into that helps buffer the solvency of annuity companies. So if the company went under, many states, they have a guarantee that backs those annuities up to $250,000, which is similar to the FDIC limits as well.
Well, Carson, the last question that was ranked high on Google regarding annuities is, are they protected from creditors?
Yeah, Andrew, I think that's a very important question. And I would always tell someone with that question to make sure you check with your state or an attorney in your state regarding that particular situation. But I will say, for the most part, annuities are creditor protected. Now, when it comes to my state here in Texas, and for my clients who may be watching this particular YouTube video, I want you to be assured that in the state of Texas, all insurance products and annuities products are completely creditor protected. So that's really wonderful if we live in the state of Texas here. But for others, you need to check with your own state and your own attorney regarding if your insurance products are creditor protected. Another important factor that I do want to point out when it comes to annuities about the protections of annuities is that all annuities avoid probate. So if you have an annuity established for your state and you're wondering if you have to put that in a trust or will, do not bother, because that annuity itself is completely protected from probate court. Thank you again for tuning in to our Financial Freedom video. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.